The subprime mortgage financial crisis in 2007 started not only the Great Recession that is still going on, at least in the Eurozone, but triggered also a revival of interest in the thought of Hyman Minsky. In my presentation, I will give an explanation of why there was a revival of his thought, and in the end I want to argue that the moment of Minsky should not be confined to Minsky moments, but also to our moment, because in order to avoid a future Minsky meltdown, we have to learn his lesson. Let's start by definitions. The crisis was called by many observers a Minsky moment, and after a while, when it degenerated in a recession, affecting also the real part of the economy, it was called a Minsky meltdown. What do we mean by Minsky moment and Minsky meltdown? Well, clearly both refer to exceptional circumstances of severe financial crisis. But if we look at the definition that have been suggested, we see that we can classify them in two groups. According to a series of definitions, the Minsky moment is in fact conceived as a point of time. In other definition, it is conceived as a process. In my opinion, there is no reason to choose between the two definitions, because we can understand the Minsky moment as the initial point of a Minsky process. This will be my approach. And the Minsky process should be understood as the phase of a cycle, of a financial cycle. In order to interpret, to explain this financial cycle, to understand the policy implications, it is very useful to refer back to the financial instability hypothesis of Minsky. As for Minsky meltdown, again, there are different definitions. All agree that the difference between Minsky moment and Minsky meltdown is a matter of degree. And I think that the most interesting, most satisfactory definition of Minsky meltdown is that we have a Minsky meltdown when the Minsky process is so deep and persistent that triggers a deep recession in the real economy. The revival of the thought of Minsky was no doubt instrumental, because the governments and also many experts advising the governments didn't know how to justify the kind of policies that the governments wanted to take at the beginning of the crisis, and that were advocated very strongly by banks, the financial institutions, and also insurance, big insurance institutions. That is a policy of bailout of banks and insurance companies that were almost all virtually bankrupted. So they wanted to be bailed out, but bailing out banks is completely against the principles of the neoliberal theory, that is the mainstream theory, according to which this sort of intervention should be taken by the government. So it was, they thought that it could be a good idea to refer back to Minsky and say that Minsky had a recipe for a big crisis, and Minsky suggested that in such a situation, banks too big to fail or too interconnected to fail had to be bailed out by governments. But this criticism of mainstream theory came with a clever way of keeping a protective belt around mainstream economics. because what they said was that, mainstream economics, of course, is the true theory for the rule, but sometimes there are strange exceptions, black swans, as someone said, and in this case, maybe mainstream economics doesn't work, and we have to refer to particular theories such as that of Minsky that are relevant for these exceptions. Clearly, Minsky would not have agreed with these interventions, with this sort of policies. He would have defined this sort of policy as destabilizing stabilization, because this policy did not address the structural causes underlying the crisis. And so, for that reason, he believed, he would have believed, rightly so, that so doing, governments were planting the seeds of a new great crisis in the future. In order to stabilize an unstable economy, according to Minsky, we have to address the structural problems and intervene with structural reforms that, however, are completely different, I would say, opposite to the structural reforms that are advocated today by the austerity hawks. You see from the protective belt that I mentioned before that a basic principle of mainstream theory is regularism. That is the idea that the theory, a scientific theory, can only be applied to regular phenomena. And this idea justifies all the well-known assumptions that are underlying this theory, the fact that the economy is always in equilibrium, that the equilibrium is stable, that the agents are fully rational and entertain rational expectations, and processes are stationary, uncertainty is only weak, and so on. Lucas, who was perhaps the mainstream economist who in the 70s clarified better the methodological underpinnings of mainstream economics, admitted that sometimes economic phenomena are irregular, but he said that when they are irregular, a very rare event in his opinion, economic science has nothing to say. So he anticipated what happened. Because science with capital S can only be done in reference to regular phenomena, to what is called in technical jargon stationary stochastic processes. Let me just say that this approach has contributed to the financial crisis because it didn't admit the possibility of a great crisis. And so this possibility was never considered and nothing was done to prevent it. And second, in this theory, as it was reinterpreted in the early 80s, there was the idea that the advances done by governments and by economics in controlling the economy were such that we shouldn't fear anymore any significant crisis. This time is different. This was the typical slogan that was repeated many times, even 2007. If you read the newspapers, the most important Italian newspaper, for example, but not only Italian newspaper, you see you shouldn't fear a crisis. Now this time is different. There is some problem, but they will be solved very easily. What we need, on the contrary, is a broader perspective that is able to explain the regularities and explain also the exception, and explain why regular phenomena degenerate under certain conditions in critical phenomena. As Minsky said, for an economic theory to be relevant, what happens in the world must be a possible event in the theory. On that score alone, said Minsky, standard economic theory is a failure, The instability so evident in our system cannot happen in that theory. So, what is Minsky theory? Minsky theory is not really a completely original theory. It is, by his own admission, basically a reinterpretation, updating and extension also, of Keynes' general theory. This is because in order to understand the world, he used to say, we have to mount on the shoulders of a giant such as Keynes. But to mount on the shoulders of the giant doesn't mean that we have to accept everything he said. And in any case, we have to develop his thought and updating to the current world. The reinterpretation is motivated basically by three crucial criticisms of mainstream theory. First of all, mainstream theory assumes that the full employment equilibrium is stable, and Minsky instead repeated what seems paradoxical, but I will explain it in a few minutes. The fact that equilibrium is destabilizing, stability is destabilizing. I will explain you why. It seems a contradiction, but it's not. Second, the mainstream economics doesn't take account of uncertainty, to be distinguished by risk from risk. That is real uncertainty, strong uncertainty, radical uncertainty. And according to Minsky, Keynes without uncertainty is something like Hamlet without the prince. That is something that is not interesting at all. And finally, the third point is that distribution of income doesn't play a crucial role in mainstream theory. On the contrary, Minsky believed that profits, the explanation of the dynamics of profits and the related problems of distribution of income were crucial to understand the dynamics of the economy. It was also an extension because Minsky explained that these three basic shortcomings of mainstream theory depend crucially on the fact that the financial conditions are not taken enough in consideration by mainstream theory. He believes, on the contrary, that they play a crucial role in explaining the dynamics of the system, at least in a modern, as he said, sophisticated monetary economy. And this is, I think, the most original and far-reaching contribution of Minsky. The development of the hints you find in the general theory on the importance of finance and financial conditions that he developed in what was called the financial instability hypothesis. And finally, it is an updating of the theory of Keynes, because Keynes himself underlined the importance of the historical condition to which we apply the theory, and he emphasized that mainstream theory, that at the time he called the classical theory, was valid for a barter economy, but not for a monetary economy. So he undertook the task of developing a theory that was able to explain and forecast what happens in a monetary economy, not in a barter economy. And Minsky is even more specific and develops further this historical element of the theory, shaping the theory for a sophisticated monetary economy. I think that in the Minsky theory there are three main ingredients. One is the financial instability hypothesis that deals with the role of financial condition of economic units in explaining the dynamics of the system. Second, there is a financial theory of aggregate investment that is taken by Keynes and Kalecki. And third, a macroeconomic accounting relation identity that is based on Kalecki and gives a general framework to his macroeconomic theory. I have only time, I apologize, I have only time to deal with the first point. And even in that case, I will have to be very simple. So let's focus on the financial instability hypothesis. Minsky starts the description, the explanation of this part of the theory by a definition of economic units. This is very important. It's very important to read this definition because it explains a lot of the approach of Minsky. Every economic unit, an enterprise, a household, a financial institution, or the state, notice, his theory applies to all these kinds of economic units, not only to banks, as someone could think, but applies to all these kinds of economic units. And an economic unit is a device of inflows and outflows of money. Is characterized essentially in its essence by inflows of money and outflows of money. As a bank, he also said we have to consider all units as if they were all banks, including households, including the state. Now, what are financial outflows? Financial outflows in a period of time are, of course, all the flows of cash that get out of the balance sheet of the economic unit. We could think to these financial outflows or cash outflows as the counterpart of expenditure. And financial inflows can be understood as a counterpart of income. Minsky starts his versions of the financial instability hypothesis from a classification of economic units. It is very well known that he distinguishes between hedge units, speculative units, and Ponzi units. I have no time to explain which is the original definition by Minsky of these three categories. I will present a slightly different way of classifying the units, because then I will use it in a model, a very simple model. In any case, I follow his approach. As in the case of Minsky, I characterize all economic units through a pair of values, through two variables, two indexes of the financial conditions of the unit. One defines the liquidity condition and the other one the solvency conditions. In my restatement, the two variables, crucial variables, are the liquidity ratio and the solvency ratio. The liquidity ratio is given by the ratio of excess financial outflows over financial inflows. To give an intuitive idea of the meaning, when it's more than one, that is, outflows are more than inflows, this means that in that period the unit loses liquidity, worsens its liquidity condition. The solvency ratio is defined as the ratio between the sum of expected outflows in the time horizon, discounted, over the sum of expected inflows in the future periods, discounted. And again, it is intuitive that if this value is more than one, the economic unit is virtually insolvent, because its expected outflows in all the period are more than the inflows. So how can the unit finance this situation? So it is virtually insolvent if it is more than one. We can consider also this index as an index of the net worth of the firm. If the value of this index is less than 1, the net worth is positive. If it is more than 1, the net worth of the unit is negative, and so it is insolvent. So we can represent in a simple Cartesian diagram all the possible financial conditions of units, but before understanding the meaning of the different conditions, I have to introduce another ingredient, the last one. I have to take account of the fact that the units, in order to risk too much to become insolvent in consequence of some unexpected shock, try to keep sufficiently far from the insolvency line, that is the vertical line at the value 1, beyond which they become insolvent. And so they try to keep on the left of the vertical 1 less mu. And the distance between 1 and 1 less mu represents the safety margin of the unit that depends on the risk and uncertainty aversion of the unit. If the uncertainty aversion increases, this vertical line shifts on the left. If the uncertainty aversion diminishes, this vertical line shifts on the right. This is important to understand the dynamics of the system. As for the red horizontal line, we will call it liquidity line, because beyond 1, the units is in a situation in which liquidity deteriorates. Under 1 is in a situation in which liquidity improves. In the light of this, we can understand that we can conceive of 6 categories of units. These are 6 instead than 3, but I will explain you very immediately why. In Minsky are 3, here are 6. Let's start from hyper-edge units in the rectangle 1. The units there do not have a problem of liquidity because liquidity ratio is less than 1, and do not have a problem of solvency because they are sufficiently far from the insolvency line. So I call them not only hedge, but hyper-hedge. But the dynamics of the system, as we will see in a moment, push these units upwards until they cross the line, liquidity line, and they become speculative. And so, from that point on, the liquidity conditions start to deteriorate. The deterioration of liquidity conditions push the unit towards right until they cross the safety line, and at that point, when they cross the safety line, they realize that their safety margin is insufficient. They are too close to the insolvency line. The risk they are taking is more than they are prepared to take. And so they react in a way that I will explain in a moment. These units are hyper-speculative because their characteristics are a worsening of liquidity condition and an unacceptable solvency. They are still solvent, but their net worth is too small, so that they fear that some unexpected development in the economy may push them towards insolvency. And in rectangular 4, we find edge units because they are still too close to the insolvency line. They are too financially fragile, but their liquidity condition improve. I consider also 2 categories that are not considered by Minsky, the units beyond the insolvency line. Why do I consider them? Because if you read the accounts of the crisis in 2008, you see that in September, October 2008, most investment banks, many banks, many insurance companies, and many also manufacturing firms were virtually bankrupted. But not all of them really bankrupted, because some of them were bailed out, others succeeded to bail in by changing the characteristic of their activity and so on, by merging. And so in a acute period of crisis, we have to consider also the units that are virtually insolvent. I call them highly distressed when they are not only insolvent, but their liquidity is still deteriorates, and distressed when they are virtually insolvent, but their liquidity improves, so that they are candidates for bailout or bail-in that could and often succeed to come back in the solvency area. So, we have, of course, here a continuum of financial conditions, but I try to give an idea in qualitative terms of what distinguishes different broad categories of financial conditions. Now, it's important to understand one point that Minsky understood very well, is that between the liquidity condition and the solvency condition, there is an interaction that is crucial in explaining financial fluctuations. As Minsky says, though textbooks may consider solvency and liquidity as independent attributes, the two conditions are interconnected. And this interconnection, this feedback, plays a crucial role. I represent this feedback in the most simple way, as you see, and the solution of such a model is a very simple solution that is the basic Lot-Volterra model as developed also by Goodwin. And this produces clockwise cycles that have the same center. The point omega is the equilibrium and is a center. So the economy, the representative point of the economy, oscillates along an orbit, and which orbit depends on initial conditions. Let's suppose that the system is on the thick, dark orbit. Now we can explain which is the meaning of a Minsky moment and the meaning of Minsky process. But before that, let's start by the point. Let's start from here, the description of the cycle. When a unit is here, or the representative unit of the economy is here, the unit that moves clockwise goes beyond the solvency line, so that beyond that it's in a condition of solvency that is considered very satisfactory and doesn't worry about insolvency. And in this area it is also in a situation of improving liquidity. And this is typical of the period of the cycle that represented the expansion of the economy, because the units, being in such a situation, try to maximize profits by increasing investment, and so doing they move upwards. Investing, they deteriorate slowly their liquidity, because investment implies that costs now to have profits later. So liquidity starts, is still positive, is still improving, but the improvement vanishes until the unit crosses the liquidity line. And this is the phase of the cycle that we can call the boom, because already before, but even more here, the investment brings very high profits. The liquidity deteriorates slowly, but no one cares, because the profits are so high that everyone believes that we'll be able to finance the debts. The units increase indebtment, and everything goes well, unfortunately, until the units reach the point A, the Minsky moment. This is what I call the Minsky moment, when the deterioration of liquidity pushes the representative unit beyond the safety line. So the unit discover that they are in a very fragile situation, and this starts a process of debt deflation. The process of debt deflation was introduced in the economic literature by Fisher to explain the Great Depression in the 30s, but Minsky adopted it as an explanation of this part of the cycle, that is what I call the Minsky process. What happens here is very intuitive, and we have seen this happening, for example, in the Eurozone. In this case, the units were the states. When the unit realizes that he's in a fragile situation, starts to sell assets. But unfortunately, since there is a strong correlation between the financial conditions of units, also the other units start more or less in the same period to do the same thing. And so after the first round, the unit discovers that its effort to reduce debt produced a reduction in the value of assets, such that the reduction of income is more than the reduction of debt. And the index that represents the indebtedness ratio of the unit has worsened instead of improving. The fact that the effect of the attempt to improve their financial solidity doesn't work produces a sort of panic. It seems impossible to come out of such an awkward situation. And so round after round, the process of debt deflation goes on, and this is the delicate part of each crisis that becomes devastating in the case of a great crisis. This is the moment in which the process of debt deflation affects also the real system, because also the firms operating the real system start to have similar problems, start to sell assets, at a certain point start to sell their strategic assets. And this jeopardizes their activity, so that they have also to fire their workers and so on. So this is the phase of Minsky process of debt deflation. And this may go on many years, in the case of the Eurozone from 2010 to now, until the representative unit crosses the liquidity line. Maybe this is what is going to happen this year, let's hope so, also for a country like Italy. And crossing this line, as Padoan said, would mean that the liquidity condition would start to improve, although you see that the unit is very close to the insolvency line, so it's very fragile, still very fragile. So the liquidity condition improved, but the unit is still very fragile, and an expected shock could still push it in an insolvency situation. Now, from the methodological point of view, this approach by Minsky, I think this represents well the approach of Minsky, is completely different from the mainstream economics that is taught today in the Faculty of Economics, because first of all, the equilibrium is not stable. On the contrary, and now I explain the paradox, the equilibrium not only is not stable, but paradoxically is destabilizing. A period of financial tranquility or financial stability produces changes in the structure of financial condition of the units, such that what was originally the equilibrium becomes a disequilibrium and starts a disequilibrium dynamic process that is typical of financial fluctuations. So in this example, the original equilibrium is omega black, and we can assume that the economy stayed in such a situation of financial tranquility also maybe 1 decade, as in the 50s or 50s and 60s. But although the economy was in equilibrium, something changed in the structure of the economy, financial structure of the economy, because the fear of insolvency gradually weakened, exactly because what the units observed was financial solidity that was going on, and profits that were able to repay debts and confirming the indebtedness taken before, so that the units gradually become acquire a higher propensity to risk and uncertainty, and this reduces the safety margin that they take in their balance sheet, so that the safety margin shifts on the right. In consequence of the shift on the right of the safety margin, the new equilibrium is the red omega, and the black omega is now a disequilibrium. Being a disequilibrium, it starts a clockwise cycle, a clockwise orbit that is typical of this equilibrium orbit, typical of these financial fluctuations. And not only equilibrium is not stable, not only along an orbit disequilibrium is persistent, but the system is characterized also by two different forms of instability: dynamic instability and structural instability. Why dynamic instability? Because while the safety margin moves on the right, it can be proved mathematically, the representative points is pushed on outer orbits. So the real movement is a sort of spiral going towards the external part of the orbit. And this means that the new orbit at a certain point is so large that the representative points turns back very, very close to the instability line. So we have dynamic instability in the sense that the disequilibrium increases in consequence of the boom and in consequence of the effects of the boom on the psychology of the unit. And we have structural instability in the sense that financial fragility increases, and a very small shock could push any unit beyond the insolvency line. But even if the representative point stays in the insolvent area, since there is a dispersion, of course, around the representative points, this movement implies that a part of the unit becomes insolvent, and this part can be a big part of the unit. So, as you see, instability is important both in the dynamic sense and in the structural sense. Very often the evolution of facts makes theories obsolete, and this is, in my opinion, this is not the case of the financial instability hypothesis. On the contrary, Minsky was really prescient when in the 60s and the 70s produced such a theory, because that theory was already valid in that period, but is more valid now in consequence of the process of financialization that happened since the early 80s. In this period, as you know, finance acquired a growing importance in the economy. For example, the financial interrelation ratio that measures the ratio between the financial capital and productive capital increased from about 1 at the beginning of the 80s to more than 3 today. The GDP share of the financial sector increased to more than 10%, while it was much less before, even in a country like the United States. And the share of profits increased to almost half of the profits produced in the economy, notwithstanding the financial sector was only a much smaller part of the economy. And the increasing importance of financial conditions occurred also in non-financial firms, also at the level of households. And so in consequence of the process of financialization, the analysis of Minsky became more and more up to date. This analysis, of course, has policy implications. Important policy implications to get out of the crisis and to avoid that a new crisis, said Minsky, happens again. Let me say, simplifying the panorama of the different theoretical and policy points of view, that in consequence of the Great Recession, we see two basic viewpoints. The viewpoint of mainstream economics that I could call also the point of view of the black swan, and the point of view of Minsky and other heterodox economists having similar ideas that see the crisis as a grey swan. What I want to say, according to the black swan point of view, a big crisis such as the recent crisis is something that is intrinsically unpredictable, is an act of God, something that does not depend on our will, on our activity, on our choices. We are used to see white swan, but maybe sometimes we see a black swan. European swans are white, but Australian swans are black, and maybe we see a black swan in a zoo. On the contrary, the point of view of the grey swan admits that swans change of color because young swans are grey, so it's a part of a natural cycle, and they appear and reappear with that color. What I want to say is that the crisis is not a black swan, it's something that it is repeating because it is related to structural principles that I tried to represent in a very simple way before. And so the policy required in the second case is completely different from the policy required if you interpret the crisis according to the first point of view. If you see the crisis as a black swan, what can you do? Basically one thing, and in fact the changes in the Basel rules and what has been changed in the laws that try to stabilize the economy and the recommendation of central banks all go in the same direction. Basically, the idea that the percentage of liquid reserves kept by units should be increased. But if we have the second point of view, the point of view of Minsky, we realize immediately that this sort of policy will not be successful, because to increase the percentage of reserves implies that the insolvency line is pushed rightwards. This is the increased theta of a percentage theta beyond the insolvency line. So if we assume that the cycle doesn't change, clearly this increases the solidity of financial units and reduces the risk of insolvency. But the trouble is that even if you impose more reserves to units, you cannot change their minds, so they will keep solvency margin exactly as they wanted to have before. So even the solvency margin is shifted in the same proportion, and so even the cycle is shifted, and the cycle turns near the solvency line, near as before. So this is a sort of Lucas critique applied to this sort of phenomenon. This sort of intervention may help in tranquil financial conditions, but not in the occasion of a great crisis. On the contrary, according to the grain swan view, the approach shifts towards the role that institutions may have, big government, powerful central bank, and they shift to the role that a constraint of liquidity or leverage may have on the stabilization of the cycle, because this is like putting a ceiling on the cycle. So I'm close to the end. I have still some minutes. To come out of the crisis, we need fundamental institutional changes, as Minsky said, similar in scope to the basic reforms of the first 6 years of the Roosevelt presidency. We must develop economic institutions that constrain and control liability structures, particularly of financial institutions, but not only of financial institutions. And in this way we can stabilize instability. So the way out is seen in structural reforms that go in a direction opposite to that advocated by the Troika. According to the Troika, we have to strengthen the market and weaken public institutions. According to Minsky, we need public institutions that do not need to be really big in the bureaucratic sense of the terms. We should keep a minimum of administration, according to Minsky, but they should be sufficiently powerful to regulate and supervise markets. This is a precondition, important precondition for stabilizing the economy, because finance cannot be left to free market. And so, let me, if I have 2 minutes, let me give some example of structural reforms that would go in the direction of Minsky. This is not a summary of Minsky, because Minsky died almost 20 years ago, so he couldn't suggest something that was fit for the current crisis. But I think that this list goes in the direction of what Minsky had in mind. First of all, we have to reduce the weight in the economy of finance. I showed before that the weight of finance in the economy increased by a factor of 3, and we should downsize finance to 1/3 at least, to recover the situation we had in the early 80s. By the way, even an economist as Rogov, famous international economist of Harvard and chief economist of IMF a few years ago, says the same thing, that we should reduce the size of finance to 1/3, to the size of the 70s. Then we need a dimensional cap to private banks and financial institutions, because no bank should reach the size that makes it too big to fail or too interconnected to fail, because this implies privatization of profits and nationalization of losses, and we cannot accept that for ethical reasons and for good government reasons. We have to introduce a cap to the leverage of financial institutions. This is also advanced by clever and insightful mainstream economists such as Giannakopoulos or Adrian and Shin. Then we need a tax on financial transactions that would be able to downsize the speculative part of finance without affecting the role that finance has of support to the economy. And already 23 countries adopted schemes of financial transaction tax, and even the European authorities spoke of that but didn't do nothing at all so far. Then we have to reintroduce a segmentation between different activities in finance, in particular investment banking and commercial banking, as the Glass-Steagall Act did in the 33. The fact that the Glass-Steagall Act was repealed in 1999 was certainly a crucial cause of the deep and persistent financial turbulences happen in the new millennium. And then we have to separate financial activities that interacting produce conflict of interest. For example, consultancy activity and revision of balance sheets on the part of rating agencies. To reach this goal, we need, of course, much improved regulation and supervision of markets, and also, why not, this is a word that it is not like today, but it is necessary, and also sheer repression of certain activities that are on the border of what is acceptable, such as the existence of offshore financial centers, or the existence of over-the-counter derivatives beyond any control, or the existence of shadow finance based on off-balance sheet operations that has a weight close to that of visible finance. These measures may look utopian, I'm aware of that. However, during the Great Depressions, the measures taken of control of finance, of repression of finance, were not weaker than what I am advocating now. This proves that it is possible to reach a consensus for this sort of measures, and these measures are necessary condition for resuming a sustainable kind of growth. And in any case, the emphasis on economic growth, says Minsky, rather than on employment as a policy objective is a mistake. A full employment economy is bound to expand, whereas an economy that aims at accelerating growth not only may not grow, but may be increasingly inequitable in its income distribution, inefficient in its choice of techniques, and unstable in its overall performance. So that policy authorities should play the role of employers of last resort. As you see, a policy strategy completely opposite to that pursued today in the name of austerity. So, in my opinion, in the absence of drastic measure of the kind, we may experience soon another great crisis, and maybe this great crisis could be the big one. So if this is true, and on the basis of the analysis suggested by Minsky, this could be true, I think we should act, and act without fear. Thank you.